Taxes aren't the most exciting aspect of real estate investing, but they're important to understand nonetheless. As a doctor who invests in real estate, it's much more fun to focus on big returns and upgrading your lifestyle. But you shouldn't overlook taxes completely. The beauty of investing in real estate is that your investments lower your tax obligation rather than increase it, unlike other investment vehicles, such as mutual funds and stocks and even REITs. Hi there, this is Harry Nima Segara with Nima Equity, and today we'll talk about some tax strategies real estate investors can use in their advantage. So let's get started. Deciding on your entity election. Some people invest through an entity or LLC, limited liability company. Deductions you may use from investing don't change where you're investing with your personal name and social security number, where you have a single member LLC, or if you have a multi-member LLC or corporation. The tax deductions are the same and include all business-related expenses. As a real estate investor, it's wise to avoid electing C corporations to set up your real estate investing business. With a C corporations, all your earnings can be taxed more than once. To simplify things as you're just starting out, it's recommended forming a single-member LLC. Most real estate syndications are formed as multi-member LLCs and are taxed as partnerships. Taxes and real estate syndications. Real estate syndications are typically set up as limited liability companies or LLCs and taxed as partnerships. The real estate syndication itself is not taxed. It's a pass-through entity, meaning that the items of income and expenses, as well as the gains and losses that occur at the syndication level, are passed on to the limited partners. The items reported on the K-1 and your cash distributions are different. The cash distributions you receive as returns on your investment are not subject to tax, to the extent of your tax basis in the syndication. Any excess cash distributions you receive will be taxed as dividends. The lead syndicators have flexibility on how they choose to allocate the various items. The real estate syndication operating agreement can be written to reflect the various allocations depending on the personal needs of the partners. Taxes and rental real estate. As a limited partner in a syndication or when you own rental property, you may get passive income or losses, which are different from your earned income or W-2 income. There is a special allowance for rental losses. If your adjusted gross income as a married couple is $150,000 or less, you can take up to $25,000 of these passive losses. However, if your adjusted gross income is higher, you cannot take any rental passive losses against earned income, unless you are a real estate professional. Real estate professionals have a special designation that allows them to take more passive losses against their earned income, since the majority of their earned income is also from real estate investments. For full-time doctors, it is very difficult to qualify for real estate professional status. There are three parameters that must be met in order to qualify for this designation. The first is that 51% of all the investors' work in time and services must be in real estate-related activity. Also, in one calendar year, the investor has to do more than 750 hours in a rental real estate trader business. And third, the real estate professional has to materially participate in their business real estate activities. A real estate trader business can include rental property management, syndication deal sourcing, brokering properties, etc. Very important, be sure to discuss your personal situation with a CPA. Changes can happen quickly, and what you qualify for 1 year may be different the next year. Small changes can impact you greatly at tax time, so always seek professional advice from your CPA or tax advisor. The power of depreciation and cost segregation. Wear and tear on a property over time is expected, and you're allowed to write off the depreciated value of a property over time. You're allowed to write off the value of residential rental properties over 27.5 years, and commercial properties can be written off over 39 years. Depreciation helps you because when you receive cash flow distributions, the tax on the amount you receive is deferred. This means you aren't required to pay taxes on the earnings from the asset until it's sold. Cost segregation increases the tax advantages even further. In typical real estate syndications, the property is held for around 5 to 7 years. By using cost segregation, you're able to take into account the various aspects of the property that will depreciate at a quicker rate. Cost segregation can speed up depreciation benefits, so investors can further tax advantages even within 5 years' time. If you're interested in learning more about active and passive real estate investing, and how to build true wealth for you and your family, we invite you to join the Nima Equity Doctors Investing Club. We'll be here to help you every step of the way. I'm Harry Nima Segara with Nima Equity. Thank you for watching.